from my own viewpoint, in financial or investment community, there are three type of manager: a good manager, the bad one, and another one is the ugly one. Now let's talk about those ugly stuff there. It's called the activist strategies, portfolio fund management. And who are they? Who are they? And I was call them is the financial vulture. They're flying around and looking for the dying animal or buddy, and then try to take advantage of it and eat it out. So they specialize in taking stakes in the list company. They look around, and then they feel that some of the weak, very weak company, and they push those company to make change and for enhance the value. They view the value that could be a good value, but it necessary unnecessary. Most of the time they use is for arbitrage purpose. It's to make money from that. Okay, so the process of their doing an investing process, of course, first one is flying around and looking for opportunity, then find those weak company as their target, and then they open attack by issuing the letter to change the company, and then they launch the proxy contacts, and then they negotiate with the management and take it over the firm and arbitrage and make money. The tactics is pretty straightforward. First, going to the board, all right? So penetrate into the board, and so from the board they change the management, and they get a support from the management and other shareholder for the proxy, right? To proxy, the proxy vote. The purpose is to change the management financial structures, all right, and by change the propose those change at the annual general meeting and the shareholder, and these financial restructuring, because they got to future support the purpose to make money from that firm by increase the dividend, even though the firm haven't made any money. So they're going to increase the dividends, and by using their power, using the first asset as collateral, and then to do share buybacks, so that it can increase the share value which they already have, and then increase their dividends and their cash flow. And then they after that they cut the management compensation, and they launched the launching the legal proceed against the management, and arguably is to launch the median campaign against the existing management, and then breaking out the large inefficient conglomerate. Right? So these are the procedure. It looks pretty ugly. What's the purpose of that? Is to get rid of the existing management, and they will go there and take advantage of it. And purpose is to sell this firm to make some profit. Okay, so this is an activist strategy. However, most of the managers are good managers. Let's talk about some good strategy here. Right, those is the active funds portfolio management, and another one is using this called arbitrage strategies. Okay, and using the statistical measurement to do that. So it's not like a fundamental approach to looking for some fundamental factor around the individual company, but instead about that is using the statistical property of mean reversion, all right, of the price movement, and create the long short strategy, and able to generate excess return, and we call the arbitrage. The reason to call arbitrage because this is really no cost. Now think about this. Now you can buy an underperforming security. At the same time, you can short the outperform security. So you're shorting those security you view have a high price, and you buy those security you view have a lower price. And the condition is that these two security are almost perfectly and positively correlated. So you can long one, short one. And this is zero cost because you go to short and then you will receive the proceed by shorting the security and then use that one to buy another security. So the net cost is almost zero. Now to do that one, you got to have a skill that you understand who are actually the underperform, who are the outperform. And that is not an easy task. And another one is using the spread concept. And let me introduce this one to you called the TED spread. T is a treasury bill or treasury note. ED is a euro dollar. So what is euro dollar? Euro dollar is the US dollar account, all right, outside the United States. All right, so that's mean in a foreign country or outside the United States, their bank account had a US dollar account. Now, since both US dollar and both short term, so their interest rate is supposed to be identical, but in fact they are not. So there's a spread between the treasury notes and euro dollar interest, and this we call TED spread. The spread itself is not constant. It moves up and down, but actually they move around the mean value of zero. This we call mean reversion of the spread. So you can actually sell the spread which is too high about the zero, and you buy the spread when they below the zero. So you do that one back and forth, all right, and you're able to generate excess return, and this we call the mean reversion spread trading. Okay, the spread trading actually taking advantage statistically is called the co-integration effect. The co-integration meaning that if you see two random variable like the interest rate in T-bill versus interest rate in euro dollar, if you look at that individually, the interest rate movement are pretty much random. However, when you put that together as a spread, it's not random. It becomes a mean reversion. So there's a pattern there you can predict. And this effect we call co-integration effect. Another strategy is called the microstructure-based arbitrage strategy. This is using the market microstructure. This is very popular today, and usually involve very high frequency trading. All right, take advantage based on the information on the limited order books. Those books in a very short period of time has some kind of out of balance between the supply and demand. So there's imbalance of supply and demand in a short period of time, and that causes this mispricing. So you're using this high frequent trading through the mispricing of imbalanced supply and demand. With that opportunity, you can make money. Okay, but this arbitrage process has to be very frequent and high speed. So usually involve only a few milliseconds to do that. So it's even though the profit is very tiny, it's like maybe 1 cent or 1/10 of a cent. But since you are such a high frequent trading and such as fast trading, the cumulative value is quite significant, and that's but this actually causes huge amount of market volatility, and this it may cause the market crash sometimes from this market microstructure arbitrage process through program trading. Another active trading are good management doing is the fundamental active investment strategy. And this one is pretty straightforward. They're using the fundamental approach. Okay, so they define the market opportunity and investment universe. With that, they identify the subset, which those security they view that one has a meaning for fundamental value, such as the PE ratio, dividend yield, and then they analyze the industry, the competitive position, and the financial report of the company. And so they can do that using the analysis to forecast the performance and convert the forecast to the valuation. So they convert the forecast to the valuation, and then from the portfolio with the desired risk profile, they rebalance the portfolio. And this is a pretty standard classical approach to define the portfolio, to find the portfolio. But there's some problem there. The purpose of I'm showing here is to show you there are some behavioral problem, right? A problem caused by the behavioral bias. What is the value trap? We always view that the low PE is extractive, but that's not necessary, because low PE could be is caused by a behavioral problem, and then the low PE may not be a good company. In fact, it's a pretty bad company, a bad stock. Another one is the growth trap. High gross value has been almost already reflect in the price. So when you select the stocks has a high, you view that at a high growth. Maybe not true, because the price has already reflect the growth opportunity, and it's too expensive. It's just too late for you to purchase those type of stocks. So this we call growth trap. These two trap, value and growth trap, is the major problem to cause the underperformance of portfolio using the fundamental investment strategy.